next week.
Proceed carefully is the thing we've heard a million times. Greg, if you're given the opportunity to redo that dot plot, what does it look like?
Well, so I think that first and foremost, the dot plot is a cat herding exercise, right? So you have, all these different forecasts being thrown into the mix. So I think the efficacy of reading too much into that dot plot is overplayed. That being said, I do think neutral is a little higher here, but not as high as suggested. So I don't think you'll see much in the way of back-end rates moving higher in terms of the dot plot.
Well, this whole curve's moving higher this morning. Greg Peters, Sonal Desai, going to stick with us. Let's get into it. Herding cats. Look at bonds right now. Big move on Friday, pushing back against Chairman Powell's pushback. And then this morning, almost on nothing. Up 10 basis points on a 2-year, 464. On a 10-year, up 7 to 427. Let's get into it and get you some movers going into the opening bell. Here's Abby.
Hey, John. Well, we do have U.S. futures to the downside right now. But first, let's look at two winners. And, of course, Hawaiian Airlines through Hawaiian Holdings absolutely soaring, up 174%, the best day in at least a year, perhaps ever. We'll have more data on that on the open. This, of course, on Alaska Airlines bid $1 billion to buy Hawaiian Holdings, and it will unite two carriers that largely serve the Pacific region. Alaska Airlines, as we will look at on the opening, down, though, more than 10%, as is usually the case for acquirers. Marathon Digital Holdings up 12%. With Bitcoin above $41,000 for the first time in quite some time. But take a look at Meta Platforms weighing on the futures. The NASDAQ 100 futures down more than the others, having to do with Mark Zuckerberg selling 185 million worth of shares in November for the first time in 2 years after the roughly 170% surge. Big outperformance to tech, right now heading to its worst day, perhaps, since October 26th.
Abby, thank you. Meta making up almost 4% of the NASDAQ 100. Coming up on this program, Bitcoin rallying, gold touching a record high.
I've seen the gold move in different directions based on interest rates and based on currency moves. So it's very difficult to really ascertain, like, it's telling me something.
That conversation coming up next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Gold is the worst thing on calling. To me, unless you hit somebody in the head with it, I don't know what you can do with it. I've seen the gold move in different directions based on interest rates and based on currency moves. So it's very difficult to really ascertain, like, it's telling me something.
Love Tony Dwyer, one of the best. Great to catch up with him a little bit early this morning as the everything rally moves beyond equities and bonds. Gold briefly shooting past the previous all-time high of 2,100. Bitcoin topping 42K, on track for its biggest annual gain since 2020. Both assets seeing sharp moves thanks to expectations the Fed is done and rate cuts could begin early next year. Let's get to the team coverage. Bloomberg's Simone Foxman and Isabel League joined us now. Morning, Simone.
Yeah, morning, John. But after gold hitting that record high against the U.S. dollar, it's actually retraced some of those gains down about 3% since then, and frankly lower than it started trading in Asia. Still up 12% this year. And so you have Tony Dwyer, you have the likes of John Stepek at Bloomberg questioning. Stepek says no one is entirely sure what's driving gold higher. Certainly part of the story is the end of the Fed's rate hiking cycle, with the markets pricing in that rate cut right now and interest rate swaps in May. But maybe it's partly de-dollarization. Maybe it's demand from wealthy buyers in emerging markets. Interestingly, check out this GTV Go, because what's happened in gold spot has not necessarily happened in gold ETFs. In fact, gold ETFs have been sellers for most of the year, with holdings down by more than 1/5 since 2020. These buyers, these gold investors in ETFs, have been driven previous rallies, and they are not there yet. We're still below inflation-adjusted highs in golds. Back in 1980, it hit 850, and that was equivalent to about $3,000 in today's dollars. But now we look at gold slightly lower than it began, and the likes of Barrick Gold, Newmont trading down in sympathy in the pre-market.
Simone, thank you. It's not just gold, of course. It's about looking at the move in Bitcoin, having a look at 42K.
Hi, John. It did hit 42,000, which is the highest level since April 2022. But now it's pared back some of those gains, but still up. It's now at around 41,500. And of course, this enthusiasm is really fueled by the speculation that the U.S. SEC will approve a spot Bitcoin ETF by next year, and that includes from the likes of BlackRock, and of course that the Fed is done hiking interest rates. So the last time this level was seen was around April 2022, when we saw the collapse of the Terra USD stablecoin. And if this rally holds, this will be the biggest yearly gain for Bitcoin since 2020. So it's going to be 3 years since then. And while 42,000 is a big round number, crypto investors are happy, it's still a far cry from the nearly 69,000 all-time high that we've seen a few years back. We're still around 39% from there. And if you look at Bitcoin's weekly relative strength index, so that's a momentum gauge, Bitcoin is hovering around overbought levels. So we'll see if this rally holds. But across the board, it's a green on the screen for the crypto universe. We have Bitcoin up, Ether up, Dogecoin also up, and Bitcoin Cash. And of course, that's really banking on the fact that there's a cross-asset rally, gold is up, and even assets and money market funds are also up, John.
What a move in Bitcoin year today. Simone, Isabel, thank you. Greg Peters, I want to come to you on the need for diversification, real, uncorrelated diversification, given that I think we've just had, according to Bank of America and Michael Hartnett, the best month for 60-40 going back to the early 1990s. And again, you see it on the screen this morning. Bonds down, yields up, stocks down too. Greg, if that's not going to break, where do you get that diversification from?
Well, so I think, in such a momentum-driven market, it's hard to get the diversification that the models predict over the short term. So, we take a long-term, medium-term perspective, and that's where the bond market really fits in. I think the real question on the table a few years ago, what was the value of bonds? What was the protective characteristic in a portfolio? So I think that's really changed on a go-forward basis. But, what happened last month, when everything rallied, it starts to break down. But I think you need to take a longer-term perspective, and I really think that 60-40 type of diversification with bonds really starts to assert itself.
Sunil, do you agree?
I completely agree, because I think bonds are that medium-term play, and the bottom line is excellent diversifiers. And beyond that, over the medium term, we're finally getting income again. It's been a long time, even with this massive rally that we've seen, which I don't think is going to stay. I do think we're going to continue to see real income coming from bonds, and that's important.
So now, what do you like in fixed income right now?
So, again, it's a difficult thing over the short term, but having said that, for some time now, we've been looking at this. I think probably the riskiest asset classes have rallied too much most recently. We do like staying shorter in duration, as we have mentioned previously. We went neutral, we've gone back to staying relatively short at this point. And I would say that going forward, we will probably be looking to stay higher in quality until we're more convinced that we are going to get some decent value out of risky assets. Right now, we think that the rally's overdone, especially in high yield.
Greg, are you on the same page?
Yes, I am. I'm very much on the same page. I think it's a high quality type of market. So you're not being rewarded to take a lot of credit risk in here. So we're definitely kind of higher quality, whether it's within the high yield market, the investment grade market we quite like, and portions of the structured products market. So it's not a time to take a lot of risk, Jonathan.
Greg, there used to be this story that credit leads. Do you still believe that credit leads?
Well, that was a story that the credit folks like to talk about. But I do think there is some rationale behind that. But with the information transfer just happening so immediate these days, I think that lead time is decidedly shortened. And it's not a financing-led sell-off or rally. So I do think it's a little different this time, as companies have turned out their debt and they've locked in low cost of capital. So I don't think it's the same type of relationship that we've seen historically.
So now just a final word from you on the same theme.
No, I would agree. This is in the current market that we have. It would be crazy to think that what the type of rally we saw last week had anything to do with fundamentals. It has everything to do with the speed of information flow and people reacting immediately to the potential of what that information holds. So I think it's very sentiment driven. I don't think this has very much to do with real credit or any fundamentals for that matter.
I can sense the frustration from both of you. Sonal Desai, Greg Peters, to the two of you, thank you. High yield spreads, 374. It's not just equities rallying, not just bonds that have been rallying, it's credit as well. Corporate debt rallying big time. I want to turn to the broader markets. It's an unwind of some of the moves we saw last week. So last week, fifth week of gains on the S&P 500. This morning, pulling back on the S&P by 0.75%. The support over the last month or so has come from the bond market. This morning in the bond market, unwinding some of that move as well. Big move on a 2-year last week of more than 41 basis points. 40 basis points plus lower. This morning up by almost 10, up 9 on the 2-year, so back to about 463 on a 10-year maturity. Further out along the curve on a 10-year, up about 7 basis points to, let's call it, 427. On a 30-year, up around about 4 to about 443. Coming up on this programme, the morning calls and later. Stifel's Barry Bannister seeing limited upside for stocks into next year. That conversation coming up next. Your opening bell is about 7 minutes away.
When data comes at you fast, come up with answers even faster. SAS Viya.
The reception, the acceptance of Purosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So a quarter of million cars in a market where there are million and million of cars every year.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Okay, 5 minutes out from the opening bell, here's the state of play. 5 weeks of gains on the S&P 500. Longest weekly winning streak going back to June, equaling that run. This morning, pulling back just a touch on the S&P 500, down by around about 0.8%. On the Nasdaq 100, a bigger move lower. So if the bond market gave the equity market bulls some comfort over the last week, it's maybe spooking them a little bit more this morning. Your 2-year last week down by more than 41 basis points. This morning, we unwind some of that. The 2-year up by about 9 basis points to about 4.63. That's the price action cross asset going into the opening bell. Let's get you some movers this morning and some morning calls. JP Morgan upgrading Carvana to neutral, $40 price target, reflecting better productivity and improving operations. Their stock is up by 3.75%. Your second call from Wells Fargo downgrading Lululemon to equal weight, removing the stock from its list of top picks due to its expensive valuation. That stock is negative 1.6. And finally, Mizuho upgrading GM to buy, $42 price target, expecting shares to rally after settling its dispute with UAW. That stock is positive 0.6%. Coming up on this program, Stifel's Barry Bannister warning of a lost decade for U.S. equities. That conversation is coming up next. Your opening bell with equities at session lows is just around the corner.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Let's get your trading week started live from New York City this morning. Good morning. 20 seconds away from that opening bell. Equity futures negative 0.75%. What will it take to break that positive correlation between stocks and bonds again this morning? It's a reversal. Last week upside down, if you will. Yields up, stocks down. There's your opening bell. Switch at the board and get to the bond market. Yields look like this. Your 10-year up by 7 basis points. 4.2664 up more at the front end. Last week, totally the opposite. Yields down aggressively. Stocks doing well going into the weekend. In the FX market, the euro 108.25, pulling back by 0.5%. The dollar showing a bit of strength again, reasserting itself against the euro that's starting to think about rate cuts. Earlier on this morning, we caught up with George Saravelos of Deutsche Bank saying he thinks this ECB goes first. He thinks they should cut, should, not will, should cut next week. 108.24 on the euro and crude pulling back by 0.8%, 73.50 on WTI. 40 seconds into the session, we're down across the board here on the S&P. We're negative by 0.75%. On the NASDAQ, we're down by almost 1 full percentage point. One stock to watch at the open, Hawaiian Holdings. Alaska Air agreeing to buy the company in a deal worth $1.9 billion US. Abigail has more. Hey, Abby.
Hey, John. Well, with that stock up 184%, heading to its best day, not surprisingly, ever since going public back in 1995. Investors are cheering the possibility that this deal will go through. Now, what is happening here is a roughly 100-year competition may be about to end because, of course, these two airlines largely serve the Pacific area. So Hawaiian Holdings for Hawaiian Air has agreed to be bought for $1.9 billion, as you mentioned, in cash and debt, would basically unite these carriers. They would retain their separate brands, but together, according to the airlines, have a larger reach. Now, it will solidify Alaska Airlines' position as the #5 domestic carrier, but there could be potential antitrust action ahead. 80% of the domestic carrier airspace, of course, airline activity is owned by 4 airlines. Plus, recently, the Justice Department did file for the JetBlue and Spirit merger to not happen, and they succeeded in busting a partnership between JetBlue and American Airlines. Raymond James actually said that the combination could or would change the market's currently moderate concentration to highly concentrated. So on this, we do, of course, have Alaska Air down 18%. The acquirer, as you know, is usually down, but maybe it has something to do with these antitrust motions. Hawaiian, on the other hand, absolutely soaring. It had been into today, down more than 53%. I think now it's down probably less than 20%, maybe even less than 10%, John.
It over until it's over. Abby, thank you. Watch this space on that story. A developing one for you. Want to get to Spotify. Shares of Spotify this morning on the move after announcing plans to reduce its workforce by 17%. Ed Lunto has the story. Morning, Ed.
Yeah, good morning, John. That 8% move higher puts it on track for its biggest jump since late October, but the stock trading at its highest level since February of 2022. This is the third trim of workforce that Spotify will have done this year, but the deepest. 17% is about 1,500 staff. That takes the total for this year to around 2,000. What Daniel Ek, the CEO, said in his letter or statement is that they've considered doing sort of smaller reductions over a period of time, but decided that, quote, substantial action now was the right way to go. Remember, things aren't bad for Spotify necessarily. They're on track to add around 100 million users this year, which would make their best year for sort of subscriber growth. But profit is hard to come by. And when you take into account the one-time impairment charges tied to these layoffs, they're forecasting in the current fiscal fourth quarter an operating loss of 93 million euros to 108 million euros, reflecting charges of around 130 to 145 million euros. They were expecting operating income, positive income of 37 million euros before that cut was announced. So you know the story. They spent a lot on podcasts, billions of dollars, then they pulled back. I guess it's tightening the belt when times are good.
Ed, I said it this morning, cutting costs costs money. You're seeing that with Spotify this morning. Ed, I want to talk about Facebook. I want to talk about Meta. Zuckerberg selling stock. First time I think in about 2 years. What's the takeaway?
Yes, it is the first time that kind of Zuckerberg Inc. has sold Meta shares since November of 2021, though I would kind of say that this is a story about philanthropy and charitable giving. So in total, it's 682,000 shares worth around $185 million, but it's through charitable and political entities rather than him selling himself. The timing's interesting, though, right? Look at the year-to-date gain in Meta stock, more than 170%, and then remember how bad things were in 2022. Zuckerberg didn't sell any stock, even if it was would be for political or philanthropic purposes that year, because financials were very poor. Investors were talking with their feet in terms of their response to his spend on the metaverse. The situation's improved, but again, I would just underscore, he has sold blocks of shares in the past. Remember that he and his wife, Priscilla Chan, have committed to give 99% of their wealth in their lifetimes for charitable causes, and that's kind of the rationale here, it seems.
Year-to-date move up by a phenomenal 162%. Ed Ludlow, thank you. Nothing to see here, maybe, listening to Ed there. The stock is lower by almost 3% this morning. I want to take a look at Uber getting a boost as the company prepares to join the S&P 500. Isabel Lee on top of this one. Hey, Isabel.
Hey, John, it's not just Uber. We also have Jabil and Builders FirstSource joining the benchmark gauge. Uber and Builders FirstSource are rising, but Jabil is kind of trading lower. I think it's probably because last week Jabil reported that it cut its first quarter revenue forecast, saying it experienced a softening in demand. But overall, inclusion in the S&P 500 is a positive for stocks because a spot in the benchmark index boosts the trading company's liquidity and it boosts their investor profile. So both factors usually prop share prices higher. And the three will replace Sealed Air, Alaska Air, and SolarEdge Technologies upon market open on December 18. I want to hone in on Uber, though. So the stock has rallied year-to-date 132%. Bloomberg Intelligence said that Uber's inclusion in the S&P is a stamp that it is the market leader. And for a few months now, investors have been speculating that Uber will be included, and now they finally are. The company has also been on a good run. It showed its second straight profitable quarter, and many expect Uber's business to continue to expand, John.
Up nicely this morning. Isabel, thank you. The stock is higher by a little more than 4%. Check out Virgin Galactic. The founder, Richard Branson, telling the FT that he doesn't plan further investments into the company. Let's get Simone on this one. Hey, Simone.
Yeah, John, this is sending shares down the most since June. Richard Branson telling the FT that we don't have the deepest pockets since COVID. The Virgin Galactic has about $1 billion or nearly, and therefore it should have sufficient funds to do the job on its own. But this is seen as pretty bad news, especially considering that last month the company worked to save about $25 million by cutting 18% of its workforce, discontinuing commercial flights for 18 months, and then also all of this trying to funnel money into its new Delta space plane. Last week, Morgan Stanley was talking about that news. They downgraded their price target to $1.75. Just a complete lack of catalysts that was their rationale behind that. Wall Street believes the company will have to ask for more funding by 2025. Branson says through 2026 it should be pretty well funded. He says he's still loving the company. It's really proved itself in its technology, and he remains one of the largest shareholders. But considering the collapse of Virgin Orbit earlier this year, that's the rocket startup, I think there's raising a lot of concerns in the market. We're looking at shares now down over close to 13.5% and down over 40% this
Brutal. $2 stock, $2 name. Simone, thanks for that. Thanks for the update. About 8 minutes into the session, here are the scores right now on the S&P 500. 45.66 on the S&P, up by 0.6% on the session. On the NASDAQ, up by around about 0.9%, down by around about 0.9% on the NASDAQ 100. A negative day here largely across the board, with the exception of the small caps. The Russell there just about positive by 0.2%. It is outlook season on Wall Street. You're familiar with that now. It's crystal ball type stuff. It's time to look into the crystal ball of Stifel. Barry Bannister expecting limited upside for stocks writing this. We see the S&P 500 topping out at roughly 4650 midway through next year as mega cap growth loses some ground to cyclical value as a result of economic growth, inflation and Federal Reserve tightness, all proving resilient. Barry, I'm pleased to say, joins us now for more. Barry, always great to touch base with you, sir. Great to catch up this morning. Thanks for being with us. Barry, let's talk about the recent rally first. What have you made of the last 4-5 weeks in this stock market?
Well, on Halloween, October 31st, we wrote a note saying the S&P would go to 44. It obviously overshot that, but we were positive going into year end. But what we're seeing in the market in the next 6 months is more of a rearranging of the deck chairs. As the economy, the growth proves persistent, the inflation proves sticky, we're actually saying that the cyclical value, the banks, cap goods, energy, financials, materials, transports, real estate, they would gain ground, and some of these mega cap tech would lose some ground on the price earnings multiple. And as a consequence, the market doesn't have a lot of upside.
Would you expect the bond market to reprice on that better data as well? And just to build on what you said about sectors, which sectors would tolerate that best?
That's just it. More of a positive economic growth, perhaps a higher PMI manufacturing. We're looking for 53 on that index. Pickup in industrial production, durable goods. Generally a strong economy. You know, it's not particularly robust in historical terms, but it's better than what was expected, not just here, but abroad, China and Europe. I go for the more deeper cyclicals. The cyclical growth names like the Apples and Nvidias of the world are pretty pricey. And I think what you do is see a rotation in the market. Not good for the cap-weighted index, but pretty good for investors who pick the right industries and stocks.
Barry, I wonder where that would leave the banks, which seem to be rallying on lower yields as much as they sold off on higher yields, which is like an upside-down world. Not the world we're told about, not the world you and I have been used to over the years. Barry, where would that leave bank stocks?
Well, some of the horror stories with real estate are probably overdone in terms of the bank portfolios. The banks are also extremely well reserved. They're practically regulated utilities now. And I would argue that there's an oversold condition in the banks as the economy holds on because of a foreseen view that the loan loss reserves will not have to go up. There may even be releases back into earnings. So I think the banks would benefit from this. Again, we're talking about a trade, a rotational trade in the market within the context of a market that doesn't really go up much.
Banks had a decent week last week off the back of that bond market move. Barry, let's wrap things up by looking back before we start looking forward. When you start to say things like the growth can remain resilient, inflation can remain sticky, and that means tech maybe struggles, equal weight S&P over market cap weighted S&P, I think that makes a lot of sense to people, just as scenario analysis. But Barry, when you look back on the year, where growth has been pretty decent, yields have been higher, and yet tech stocks have managed to tolerate all of that and a whole lot more. Barry, what's your understanding of what's happened in the last 12 months, which makes you think it might be different in the next 12?
Well, the one thing that we probably could have caught and understood better was that after a 10-year period of prosperity for the technology sector as a whole, remember Meta's year of efficiency, well, what were they doing the prior 10 years? So what those companies did was cut costs. They had built up a lot of fat, and just like a person, they were able to lose that 10 pounds and keep those margins up.